portfolio is red, red, minus. Every time you check, it's worse. The news screams about crashes, recessions, and corrections. But should you panic? Buy more? Sell everything? Or just close the app and cry? Before making any moves, market crashes in history have created new millionaires. This might be your chance to become rich. What? How do you do it? Before we start, let's first understand, why do stock markets crash? Is this normal or how do you survive a crash? And most importantly, how do some profit while others lose everything? We'll cover everything you need to know about stock market crashes. Let's get started. Section 1. Why do To understand stock market crashes, we first need to know why they happen. A crash is when the stock market suddenly, meaning many stocks fall sharply. This usually happens for 3 reasons: bubble bursts, black swan events. Let's break them down. The first is bubble bursts. You've probably heard the word bubble in the stock market, but what does it actually mean? A bubble happens when stock prices go way higher than they should because of hype, not real business growth. And when investors realize this, they all sell the stocks. Prices drop hard. A real-world example is the dot-com bubble in the early 2000s. The internet and investors threw money at any company with .com in its name, even if it had no profits and this model. At its peak, over 400 internet companies went public, and the Nasdaq, the tech-heavy index, by over 800% in total. But when people realized most of these companies were not making money, they sell all their stocks, and the bubble popped. The Nasdaq, a tech-heavy stock index, crashed near cent, wiping out trillions of dollars in market value, and needed 15 years to return to its original price. That's how bubbles work. Hype inflates prices, reality pops them. Then, the second reason, economy and certain policies. Bad economic condition, like when inflation is too high, makes food and rent expensive. People cut back on spending, which means businesses make fewer sales. When a company earns less, expect lower profits in the future. So, they sell the stock and the price goes down. If this continues, recession, when the entire economy shrinks. Production slows down, spending drops, and investors causing the stock market to fall even further. That's why recessions are often linked to stock market crashes. Certain policies can also cause crashes. When the inflation rate is too high, the central bank raises to slow down the inflation, making loans more expensive. Businesses that need money are struggling, so people start saving money and spend less, which spreads panic and pushes stocks down even more. Every time this guy announces interest rate changes, investors are worried. If rates go up, loans get more businesses, and stocks usually drop. If rates are cut, loans get cheaper, businesses have more money, and usually rise. The third is black swan events. Black swan is just another name of unexpected like wars, pandemics, terrorist attacks, financial scandals, and more. These kinds of shocks make people worry, which makes people get scared and sell their stocks as fast as possible, causing prices to crash. Is the 2020 COVID-19 crash. Nobody saw the pandemic coming, and within weeks, global markets are 30% because investors panicked about businesses shutting down and the world economy collapsing. So are the main reasons behind a stock market crash. Of course, there are other factors too, like too much leverage, or even herd behavior. But we won't go deep into those, since I want to keep this video simple. Now, stock markets crash. But the real question is this normal, or should you be worried? Let's find out in the next section 2. Are stock market crashes normal? Yes, stock market crashes are normal. The stocks go up all the time. It moves in cycles, with ups and downs. If you're investing for the long term, you need to crashes are part of the game. In fact, for traders, these ups and downs are opportunities for them to buy low, and because if stocks only went up, everyone would just invest long-term instead of trading. Believe it shows that the market follows a repeated pattern of market downturns. The first is pullbacks, when stock around 5 to 10%. This happens almost every year and is considered normal market movement. Is corrections, when stock prices drop 10 to 20%. As the name suggests, corrections happen when that the stock prices are overpriced and corrected back to their fair prices, usually every 1 to 2 years. Third is bear markets, when stock prices fall around 20 to 40%. This usually happens every 5, often due to economic slowdowns or rising interest rates, because the economy isn't always good like a. And the last is crashes, when stock prices drop 40% or more. These happen about once in 20 years, usually due to black swan events like financial crises or global disasters. So, with differences, feel free to take a screenshot. History has proven again and again that the market bounces back and eager after every crash. In 1973, the oil embargo crash sent markets down by nearly 50%, and it took about 7 to 10 years to fully recover. During Black Monday in 1987, the New York crashed 22% in one day, but recovered in 2 years. During the 2000 crisis, the S&P 500 crashed nearly 50%, but eventually recovered in 4 years. When the COVID-19 crash, the New York Stock Exchange dropped 30% in just 5 weeks, but fully recovered. Different crashes, but the same pattern. Market falls and come back even stronger. Who lost money? Those who panicked and sold. And who made money? Those who stayed calm and held strong. But some people still panic and say historical performance doesn't guarantee future results. What if this time different and never recover? How do we know? That's not completely wrong, but there are indicators to help. Crash is just part of the cycle and when you should actually be worried. Crashes are normal if you see still operating. People still can spend and do leisure, and some actions have been made to stabilize things. Most likely will recover. But this mainly applies to big, stable economies like the US. In smaller countries, crashes can take longer or recover differently. So you need to understand your country's condition. You should only start to worry if the entire economy breaks down. Like if businesses keep failing, banks go bankrupt, access their money, and the country defaulted on its debt. Those situations are extremely rare, but if they happen, yeah. That's the kind of crash that's much harder to bounce back from. Now you understand which crashes are normal or not. So your next question is, how to survive during stock market crashes? Well, let's find out in the next section. Section 3, how to profit from a stock market crash. A stock market crash might seem like the worst time to invest. You might be wondering, how do you even survive it? But here's the surprising part. Many people actually make huge during a crash. For smart investors, a market crash is one of the best opportunities to build long-term. Like Warren Buffett said, be greedy when others are fearful. So how do you actually do that? Common mistakes and what you should do instead if you want to profit during a crash. The first mistake is when people see their portfolio turning red, their first instinct is to sell everything before it drops more. Here's the truth. You haven't lost money unless you sell. A stock might be down, but it still has a... But if you sell at a loss, that loss becomes real. If you invested in strong profit, there's usually no reason to sell just because the market is down. Instead of panic selling, stay calm, and focus on the long term. The second mistake is trying to time the bottom. Some investors pick the lowest point of a crash and wait for the perfect moment to buy. But the problem is, how predict the lowest point? Many people wait too long and miss the lowest point, while others buy too prices won't drop further, only to see them fall more. Instead of guessing, a better strategy is dollaring, or DCA. DCA means investing a fixed amount regularly. So you buy more low and less when prices are high. This removes the stress of trying to time the market. And as long as you buy profitable companies, DCA should be a worry-free approach, as long as you're confident in the company's long-term. The third mistake is buying bad stocks just because they're cheap. If you noticed, I keep emphasizing buying good and profitable companies. Why? When stock prices crash, it's tempting to buy anything that looks like a bargain. Not all companies recover. Some businesses fail completely, and their stocks never bounce back. That's why it's important to focus on strong, profitable companies. Those with low debt, solid earnings, history of surviving tough and good prospects. During a crash, great companies become cheap not because they're bad, but because everyone's... For example, before the 2008 financial crisis, Amazon stock was at around $90 per share. $1,000, you could only buy 11 shares. When the crash happened, Amazon dropped below $40 per share. With that same $1,000, you could have bought 25 shares instead. If you had done your research and was a strong, profitable company with good future prospects, you could have bought it at that price. A few years on rebounded and skyrocketed, reaching over $3,000 per share by 2021. That's 1,000% growth. That means those 25 shares from the crash would have been worth over $75,000. And if you're interested in investing, Moomoo is a good platform to try. Click the link below to get up to 15 free stocks and enjoy 8.1% APY on idle cash. Then, the fourth mistake is not diversifying. Investors put all their money into one stock or sector, thinking it's a sure bet. But when a crash happens, fall harder than others. Smart investors spread their investments across different sectors, like tech, healthcare, consumer utilities, so that if one area crashes, others can help balance the losses. Some even diversify stocks, like bonds, commodities, or international stocks to protect against stock market crashes. If individual stocks sounds hard, then you can consider buying funds, like ETFs or index funds, which make it easily spreading your investment across multiple stocks. This way, you don't have to pick individual companies yourself. To understand more about funds, check out my other video about ETFs, mutual funds, and index funds. Link in the description. Last mistake is FOMO, or fear of missing out. When panic spreads, people blindly follow what... If everyone is selling, they sell. If the news is predicting doom, they believe it. But even legendary Benjamin Graham and Peter Lynch have said that even Wall Street professionals cannot predict the market perfectly. So understand what you're buying by doing your own research. And if you're still unsure, it's totally okay to speak to a financial... But either way, you should always understand what you're investing in. Never blindly follow anyone, not even the pro. Like Warren Buffett says, never invest in something you don't understand. Now those are the common mistakes and for beginners. But there's one more strategy that some professionals use to profit from a crash, which is called short selling. When you bet that a stock's price will drop. For example, imagine your friend owns a stock worth $100. You borrow it, sell it for $100, and wait. If the price drops to $70, you buy it back, return it to your friend, and keep the $30 difference. But if the stock rises instead, say to $120, you have to buy it back at a loss. Some legendary investors made billions shorting the market, but it's extreme. That said, I'm only explaining it for knowledge. I don't recommend it, especially if you don't fully understand how it... So, in conclusion, a stock market crash feels scary, but it's just part of the cycle. Historically, market has always recovered, and even reach new highs after crashes. While no one can predict the future, shows signs that recovery is likely unless the economy completely collapses. The key to surviving and is staying calm, avoiding panic selling, doing thorough research, and buying quality stocks at a discount. Panic sellers lose, but smart investors turn crashes into their biggest wins. So when the next, don't fear it, but be ready. If you want me to make other videos explaining these topics, please like and subscribe.